All right, as 2022 comes to a close, we are focusing in on some 2023 forecasts that we've heard from Wall Street this year.
We are expecting an economic slowdown, and with that slowdown, we're expecting inflation to also come down.
Pretty much everyone is expecting a recession.
Right now, the labor market doesn't look like it's on the verge of a recession. In fact, it looks like a market that still needs people to come off the sidelines.
We do think the peak in inflation is behind us, but inflation is likely to remain elevated into the first half of next year.
Any acceleration in 2023 from this year is going to be quite grudging, and it's just not going to be broad-based.
We think that they'll probably start cutting rates in December of next year.
So there's a lot that people sort of disagree on going into this year. When will the Fed start to slow down? How much will the economy actually slow down? But directionally, there's an enormous amount of agreement, right? Inflation's going to start to decelerate, and we are going to see the economy really decelerate as well as the Fed interest rate increases start to bite. I took a look back at the end of 2021 to see what the predictions were like for this year. I wrote about it in today's morning brief. You always get strategists like making their forecasts, then they adjust throughout the year. But the forecasts that they make going into a new year, they tend to not be spot on, of course. And so now as we look ahead to 2023 and you look at the forecast, I think the median forecast is somewhere around 4,000 for the S&P 500 is what we're looking at now. 4,009 is the average here. So we'll see where we actually end up. An anemic increase is what most strategists are looking for.
Yeah, I think if there are two things in terms of where the Fed is going to be focusing or continuing to focus its attention and taking it from that perspective of their dual mandate and looking at employment and then looking at pricing. On prices and price stability, it's really a matter of where you see the stickiest areas of inflation within prices starting to retrace a bit. And that's around necessities. That's everything from what you're paying to fill up the gas tank, but also what you're paying on your electricity, what you're paying just in your housing. And so with all of that, it's going to be the continued deceleration in price increases there, and then the retracement, hopefully, of some of those prices as well, so that consumers can feel a tad bit better, at least year over year. But we're going to have to see a trend lock in place there. And in unemployment, they've said that, look, they're willing to, or at least expecting to see unemployment and the unemployment rate tick up, as a recession is a very real kind of inevitability that many economists that we've discussed, as you saw through that clip, had pointed out. And so within those dual mandates that the Fed does have, I think those are the two key areas that the market, within any data that we continue to get, is going to latch onto, just looking for a trend. And what that trend is, whether it's 3 months or 5 months, that's exactly where we could see some actual reaction from that.
Hi, good evening, everyone. This is Hillary here. So first off, I wish you all a happy 2023. So when you see me here tonight, that means that tonight I'm going solo again. As Caden mentioned to us this morning that he's slightly feeling a bit under the weather. So he says that, okay, Hillary, tonight you try to do it solo. So okay, I have to do it. So tonight is going to be another very short session as well, but information full. So I think my colleague has already uploaded the slides. So let's jump right in. So earlier on, I believe that you have saw the video that is very nicely done by Yahoo Finance. And give me a moment. I think my slides are kind of being stopped. Okay. Let me share my screen again. Sorry for the slight hiccup. Okay, can. So now I'm back online. So sorry for the slightly technical thing. So earlier we've seen through the Yahoo Finance video, and then we heard some terms like Fed, FED, interest rate, and then the inflation is going down, and the economy is also going down. But for a non-financial person, when we hear that, we know that what is interest rate, we also know what is inflation, but what is the correlation then between them is like, we are not sure what it is. But we heard one thing, recession. So if you have followed through our YouTube channel, you'll be able to see that we have actually done a few of the videos on recession. And to find us on YouTube, you can type in Value Investing Academy. And this channel is being nicely done by our content director, Susie. And I will encourage you to explore the shorts, which she done it a very good job to show a lot of different kinds of financial knowledge and also financial contents about the shorts, such as some of the some of the wisdom by the famous value investors, and also how to build your wealth, and also some of the later topic like CHIPS Act, and also Tesla stocks, so and so. So other than that, if all these shorts are actually under 1 minute, which is very bite-sized, so it's very easy to watch. And if you have more time and you wanted to have a bit more content, you can also click onto the live, where we also share some of the stocks that the famous investors or the financial websites that they share. And also we also do some case study on certain stocks like in the banks. And also we also explore some recession-proof industries. But tonight, we are going to look into 2023 market outlook and some of the cheap stocks. So if you like our content and wanted to get the latest content, remember to subscribe or scan on the QR code. And yes, hello Salome. Okay, so without further ado, let's jump right in to this year's market outlook and also some of the blue chip stocks. So before that, we'll do some disclaimer. So the purpose of this YouTube live is to illustrate the application of value investing methodologies and also various valuation methods in the context of a real-life company. So all this information that we shared here is not a recommendation to buy, sell, or hold any stocks, because we does not take into the account of individual characteristics, profile, and also the risk appetite of given investors. So in no event shall VIA or any author be liable to any viewers, guests, or third party for any damages of any kind arising out of this use of any content shared here. And we are not operated or affiliated with any broker, dealer, or licensed financial advisors. So with the disclaimer done, we'll go into the main topic. So first off, 2023 market outlook. So here in this news by Reuters, they are exploring what the investors are looking at as a potential heavens during a recession. So here they mention from US healthcare sector to US stock and so gold, these are seen as a potential heavens because they are worried that the Federal Reserve interest rate that is increasing will bring a downturn in the economic, which is this year. So let's look into what does this actually means. Like, how does the Federal Reserve interest rate will influence the economic? So with that, we will also show one video which is also very nicely done by CNBC that they explain in detail, like how does the Federal Reserve, which is the US government bank, influence the stock market. So with the help of my colleague, Irfan, we will play the video first.
When it comes to money, there's one group that's more powerful than every trader on Wall Street. That would be the government's bank, the Federal Reserve.
People listen to the Fed and they respond to what the Fed says about the future.
When you listen to the Fed, you get at least one studied outlook about what the future is going to look like.
The Fed's press conferences, held every 6 weeks or so, tend to cause swings in the stock market.
Over time, central banks have moved from being very secretive about what they're doing to being more transparent about their policy decisions. And part of that transparency is signaling where policy is likely to go in the future.
The Federal Reserve has hiked interest rates 7 times in 2022. That's a relatively rapid pace. This and a historic drawdown in the bank's bond portfolio is weighing on stocks across the board.
But there's a lot of other forces that are affecting the economy.
By the time they usually start trying to slow things down, it's gotten to a pretty bad situation.
So how does the government's bank use words to control stock prices? And how can investors take a soundbite and turn it into profit? Forward guidance refers to public comments made by leaders of the central bank.
Let's talk about forward guidance in 2 different ways. The first way the Fed does forward guidance is actually a very overt way, which is it tells you how they think the economy is going to evolve. The other way the Fed does so is in language, which can be very subtle.
Some economic models say forward guidance is incredibly powerful.
The idea was that by changing people's expectations of the future, you can change their behavior in the present to make the present better.
Here's how it works. A member of the voting committee makes a statement. The statement contains a vague but definitive description about a forthcoming action.
We side by side compare the statements that it release month over month, highlighting the differentiation and like a word. Literally, people in finance get hung up on a word. There is a little bit of tea leaf crystal ball that certainly goes into parsing the Fed words.
Investors cracking the Fed code are listening for key phrases like
softening of labor market conditions,
or
we expect to maintain an accommodative stance of monetary policy until these outcomes, including maximum employment, are achieved.
If you notice what Powell said during the pandemic, we're not even thinking about raising interest rates. That's forward guidance. When the Fed says
we're buying 120 billion in securities per month across the Treasury curve, that's also adding to accommodation.
That's forward guidance. It's a very powerful tool.
Some of the most potent Fed statements are about the future path of short-term interest rates.
The Fed sets the interest rate that it pays on reserves held by banks, sort of the same way your bank sets the rate it pays on deposits.
There's this connection between short-term interest rates that are closely connected to monetary policy and the interest rates on mortgages, auto loans, things like this, that would be more relevant to household decisions.
The Fed sets a target for these interest rates about 8 times a year. Over the past 20 years, the target has stayed low, with extended periods at 0, a historical anomaly. Economists say that taking this interest rate below 0 is a bad idea.
You can't set an interest rate less than 0 because people would just store cash in their mattress instead of investing it with you.
And all this was because they didn't see the ability to add accommodation to the economy.
So instead, the Fed tries to set expectations with their words.
Everybody does their best to set expectations going forward, depending on what this guidance is. And like the 8 words that they change monthly is something like everybody drools over and tries to get their crystal ball and say, oh my God, that's what they're really thinking.
We would think that maybe you could get a couple of percentage points. So effectively having negative 2% interest rates through these alternative tools.
That said, people at the central bank say many outside forces affect prices in markets.
It's not the case that the Fed can perfectly control how investors or markets will respond to its statements.
As you saw in 2022, when expectations were behind the curve and suddenly they had to change policy very quickly and hike very rapidly, the markets did not like that at all and sold off very hard because then there was this disconnect.
Hi everyone, welcome back. I hope you have enjoyed the video shown by CNBC to explain what Fed really is and how they actually influence the stock market by releasing their forward guidance, and where the financials actually refer to their forward guidance, listen word by word to determine what is the government or the government banks is going to do. And with that, we decided to do a slightly slower pace to understand that how does the interest rate will influence the inflation. So first off, you look at this diagram, at first glance, it's like quite a lot of things to digest, but bear with me. So first off, we'll look at the first part, which is the interest rate. So if the interest rate is low, that means that here we can see when the interest rate is low, it will induce a higher economic growth and also cause a faster inflation. So what does this overall actually means? So it means that when the inflation is low, it has higher money supply because many people can borrow more money, and with more money, they can have more spending, which drives up higher demand for goods. So when there's a higher demand for goods, it means that the production will also increases and also cause more jobs to be released. And with that, it will cause a high inflation in terms of the food, the gas and oil, the utilities, and also the housing prices, the mortgages. So with that, it can also cause higher paychecks and induce the economy to grow because more jobs are being released. And also it helps the borrower because the borrowers can borrow more money but pay back at a lower interest rate. So this is how, when the interest rate is low, it can cause inflation to go high. So now we'll look at why does the Fed increase the interest rate will reduce the inflation and possibly cause a recession. It's because when the prices keep on increasing over time, these are some of the negatives for high inflation, which is higher expenses. So the other two we'll also explore shortly. So let's have a look. When the interest rate increased, it will cause a lower economic growth and slower inflation. So how does this actually happen? Because when the interest rate increased, that means that it's much more expensive to borrow money where they need to pay a higher interest rate. So there will be lesser borrowing. With lesser borrowing, that means there will be lesser money supply. So people will have lesser spending. And when there's a lesser spending, it also causes a lower demand for goods. So when the demands are lower, it will cause the inflation to slowly slow down. However, when the demands are slowing, that means the production is also dropping. So in a way that the economic growth also slows, and if it's too much, it will also trigger a recession. So this is why when the interest rate increase too high, it may trigger a recession. So this is the explanation between the relationship between interest rate and also the economic. And now let's look at some of the market outlook by the investment bank. So this one, the first one is BlackRock. So they foresee that the central banks will increase the interest rate to rein in the inflation. And due to the high interest rate, they may cause an economic damage or a recession. But they expect the inflation to cool down, but still remains higher than 2%. So this is one of the market outlook by BlackRock. Next, we will look at JP Morgan. So JP Morgan also expect the same thing, where the economic growth will slow down because of a high interest rates. And even though the global economy remains depressed, but they don't see an imminent risk of sliding into recession in early 2023. However, they expect a US recession before the end of 2024. And now let's look at what Goldman Sachs has to say in 2023. They do not expect a recession, but a soft landing. So here, the soft landing actually refers to they expect the inflation to be reversed without causing a recession. So how to do that? First thing is that to slow the demand growth. So here they use the term below potential GDP growth. GDP, that means how much is the country producing to combat the inflation. And next thing, they also expect the labor market rebalancing, which is the shrinking jobs and workers gap. So earlier on in the previous slide, we saw that when there's a high demand, there are also a high job openings. So when the demand drops, then the job demand also drops. So in a way that when the job demand drops, there's a shrinking of the job workers gap, and a softer wage growth. That means people has lesser money to spend, in a way that it also dampens the inflation problem. So these are some of the market outlooks by these investment banks. Okay, so now we have gone through with US. So now let's look at Singapore. So for Singapore, by UOB Private Bank's Dr. Neo, he expects that there will be a high Singapore core inflation. So what is a core inflation? So this is the latest figure in November. We see that core inflation is about 5.1%. So for Singapore, our consumer price index, we actually keep trace of these 6 categories of item, and core inflation does not include private transport and accommodation. It only keeps track of 4 of these, which is the utilities, services, food, retail, and other goods. So they expect the inflation to stay elevated for the next few quarters, and the price may continue to rise, but at a slightly slower pace. And next, they also expect a high interest rate in order to tame the high inflation, and also a higher probability of recession, but they mentioned that they expected it to be mild. So this is some of the outlooks for Singapore this year. And now, what can we do in high inflation environment? So in this article, they actually mentioned a few things, so I'll list it out. First thing, they expect that the market will be volatile, so they encourage investors to frequently review the portfolio to keep track of your financial goals and also manage the risk to determine whether is your investment encountering any high risk. And then another thing they also encourage is to diversify, especially into defensive assets. In this article, they actually suggested something like bonds for high yield, which is our Singapore savings bond. And another thing is that they advise to avoid timing market. And one of the strategy that they suggested is dollar cost averaging. So what does it mean as dollar cost averaging? So here we look at this diagram. We see that when we found one stock that we like and we wanted to invest in, some people may say, I have $8,000 and I want to do it in one lump sum. However, during the period between January until August for the next 8 months, the share price will increase, decrease, as you can see here. But until August, the share price remains at the start of January, which is $10. So in a way that if the money is invested in a one lump sum, the return might end up at 0. But if you do it as a monthly investment of $1,000, this is known as a dollar cost averaging technique. So every month you invest $1,000 into the stock. When it's high, you may buy lesser of the shares. But when the share price is low, you will buy more of the shares. So in a way that until August, they expect a return of 4.07%. So this is one of the strategies that they suggested. And they also advise to stay invested to beat the inflation. It's because when the money is not invested, it may lose the purchasing power. So imagine that even though the money is safe in the bank, it's very safe, but we know that the interest rates in the banks are quite low. And some of the savings banks right now maybe have offerings higher rates, but you need to do a lot of things and also jump through a lot of hoops in order to get the high interest rates. So they suggested to stay invested to beat the inflation. Okay, so now we have done with the first part to understand how does the interest rate will affect the economic. Next, we will look at, for investors, now they wanted to invest into the companies that can generate income regardless of their business cycle, which is our next section. And this is one of it, which is the blue chip stock a good investment in 2023? So why are we looking into blue chip stock? One of the things is that it is a high quality companies where they have a lot of good managers, managerial excellence, and also there are some of the well-known brands that we know of that people want to use. And also they are older and also well-established companies compared to the younger companies like in the growth companies. And they have actually shown resiliency during recession because they have gone through certain recessions, but they are still around, which we will see some of the companies. And as such, the resiliency is shown that they have proven history of steady growth and also staying power. And this is one of the reasons why people will look into blue chip stock is because they have dividend payout, which is a kind of a regular income. And the 30 largest US blue chip companies are actually tracked by Dow Jones Industrial Average, which is DJIA. So now let's look at what is Dow Jones Industrial Average. Okay, so Dow Jones Industrial Average is one of the stock market index that track the 30 largest US blue chip companies. And it is one of the oldest market index. It's around since 1896 and one of the most commonly followed equity indexes. As you have heard some of the announcers mention about Dow Jones, which is this stock index. And they cover all industries except for transportation and utilities. And these are the 30 largest blue chip stocks in the Dow Jones. So we can take a screenshot to have a look like which are the 30 largest US blue chip companies in the US. Okay, so now we know what is Dow Jones, but what is the difference between Dow Jones and S&P 500? As Kader always said, invest in S&P 500. Okay, so for Dow Jones, it tracks the 30 largest US blue chip companies. And for S&P 500, it actually tracks 500 large cap US public companies. So for Dow Jones, they're actually price weighted, meaning that they track the share price of these 30 companies. But for S&P 500, they are market cap weighted. So here is the mathematical formula for market cap, which is number of shares times stock price. So another term for market cap is actually the size of the company. So for S&P 500, they rank the company by the size, which is the market cap. So here we look at the sector breakdown for Dow Jones. So the largest sector that they keep track is healthcare, but for S&P 500 is for information technology. So these are the main difference between Dow Jones and S&P 500. Okay, so now should you invest in blue chip stocks? So now let's look at some of the pros if we are to invest into a blue chip stock. So first off, longevity is because this business has been around for decades and they have shown their ability to survive through market downturns. Because we don't want to invest in something, then suddenly they went into bankruptcy and our money that is invested will be gone. And next is stability and reliability. They have shown a strong track record in their good earnings and also consistent performance over the long term. And also these are some of the brands or the names that we recognized. And definitely we look into their dividend payout, which there's a financial ratio that we look at is dividend yield. So what is a dividend yield? A dividend yield is actually a financial ratio to show the return of an investor that will earn if they only receive the dividend payments. And this is the mathematical formula for dividend yield. So the higher the payout, the higher the dividend yield. Okay, so now here, we investors like to look all sorts of recommendations and find out which one is a good deal for us to invest in. So here, they actually recommended the 10 best blue chip stocks to buy in 2023. However, here is actually not a recommendation to tell all the audience here to say that now these are the 10 best blue chip stocks that you have to buy now. It's just that we are curious what are they suggesting, which is this 10, but because due to time constraint, we will look into among the 5 of them. And as I mentioned, this is not a recommendation to buy, but for something for us to be aware that, oh, these are some of the companies that is around. And next I wanted to show is that how does Warren Buffett decide to invest in the certain companies is because he has certain commandments that he has. So we will look through this short, which was nicely done by Susie again, to see that what Warren Buffett actually looks in before he invests in.
The first is that a stock is part of a business. You can't think of a stock as something different. You value a business, and then you divide by the shares outstanding. What you have to think about is what kind of a business are you getting into, what are its economic characteristics, who are its competitors, what's management like, all of these things that relate to a business instead of a little ticker symbol. I used to know when I was 11 or 12 the ticker symbols of every company virtually on the New York Stock Exchange. I didn't know what was behind them. So I had to start looking at these little symbols or these little names in the paper as businesses and decide how do you value a business, what counts.
Hi, welcome back. I hope you have enjoyed the shorts that is done by Susie, which I think is very nicely done. So now we know that for Warren Buffett, when he invests in, he does not look into stock ticks or stock tips, but he look into the company to see what kind of business they are in and then whether is it worth to invest in. So with that, for this session, we'll look at some of the simple financial metrics for us to quickly screen through the companies to determine whether is it something that worth our time to further investigate in. So the first thing that we will look at is their revenue. So the revenue, this is the mathematical formula, but in short, is the sales that the company can be generated. So we wanted to see that it's a positive and consistent uptrend based on value investing methodology. Next, we will also look at their earnings per share. So this is the mathematical formula for earnings per share, which means that for every share that an investor purchased, how much earnings can the company be generating? So if let's say the earnings per share is 10, so that means that for every one of the shares that the investor purchased in, the company is able to generate an earnings of $10. So based on value investing methodology, we would like to see that the trend is a positive and consistent uptrend. And next, we will look at their cash flow condition, which is via operating cash flow. So this cash flow means the cash flow is generated from normal business activities. And if it's a positive operating cash flow, means that there's cash coming in from the business activities. But if it's a negative, that means the company is actually bleeding cash to keep on with the operations. And the trend that we wanted to see is positive and consistent uptrend as well, which is the same as revenue and earnings per share. And finally, we wanted to know how is their debt condition, and we'll look into this financial ratio known as debt to equity ratio. And this ratio actually helps us check on the company's long-term debt situation. So why is this debt to equity ratio very important? Is because imagine that a company is like a pocket. So if there's a big hole in the pocket, that means no matter how much money can the company earns, the money will flow out from the hole. So this one will let us know that whether is there a big hole in the company. So this is the financial ratio that we wanted to see. And based on value investing methodology, we wanted to see that this ratio is less than 0.5. So in short, that for every $100 of the equity that the company takes on, they cannot take more or they cannot borrow more than $50 of the debt. Okay, so first of the company that we will look at is the Home Depot. So Home Depot is an American multinational home improvement specialty retail corporation, which we have seen here in the diagram, in the picture. And they operate more than 2,300 warehouse format stores in US, Canada, and also Mexico. So they sell the products both in stores and also online, such as this product line. And the dividend yield that they generated based on the latest result is 2.38%. So now let's look at their financial metrics. So for their revenue, it's a positive, consistent uptrend. And EPS, the latest one is almost 16, and it's also a positive, consistent uptrend. And their operating cash flow is also another positive and consistent uptrend. However, for their debt to equity ratio, we wanted to see that it's less than 0.5, but we see that it has been quite a high debt, but the latest debt to equity ratio is at 0. So with that, we have to investigate into their annual report and find out what happened. So from here, we actually found out that there actually has a huge increment in their share buyback, which lead to a negative equity, which is the reason why the debt to equity ratio is equals to 0. And next, the next company we will look at is Visa. So it's an American multinational financial services payment processor. And it actually facilitates electronic fund transfer via credit cards, debit cards, and also prepaid cards. And this is actually how it actually works at. So when the consumer paid, and then they will provide these services, the VisaNet, to process the payment so that the merchant will receive the payment from the consumer. So this is how the Visa actually works as a payment processor. And it operates more than 200 countries and process more than 160 currencies. And we'll look at, they are actually involved in consumer payments, B2B, which is business to business, person to person, and also business to consumer. And these are some of the value-added services that they also provide besides offering the VisaNet payment processor. And now we'll look at their financial statements. So their revenue is also a positive, consistent uptrend. And the EPS is similar as revenue, which is a positive, consistent uptrend. And when we look at their cash flow condition, it's also a positive, consistent uptrend. And the debt to equity ratio is slightly higher, but we can see that it's maintained at quite a stable state between 0.6. But this is something that the investors should take note of, that they are having quite a high debt to equity ratio, but there are also other financial ratios that we will look at to determine if this is a good company to invest in. So with all this look around, we will see that, okay, Visa is something that we are interested to look in, but it's not an indication to buy this company for the moment. Next, we will look at Johnson & Johnson. So it's a multinational healthcare firm where they are one of the manufacturers for the COVID-19 vaccine. And they have three main divisions in pharmaceutical, medical technologies, and also consumer products. And they're actually founded since 1886. So we can see that it's a very long history company. And the products are sold more than 175 countries. And the dividend yield that they generated is about 2.51%. However, the company has announced in November 2021 that they will split into two companies, where pharmaceutical and medical technologies will be one company, and consumer products will be another company. However, what is the name of the new company is not released yet. Okay, so now let's look at some of the financial numbers. So the revenue for Johnson & Johnson is a positive and consistent uptrend, then followed by EPS. So here has a sharp drop is because when we check into their annual report, they actually have to pay a very high tax due to the Tax Cuts and Jobs Act. But if we ignore this sudden drop in the high payment of tax, we can see that it's a gradual increment for the EPS. And for the cash flow, it's also a positive, consistent uptrend. And the debt to equity ratio, we are pleased to see that it's less than 0.5%. I'm sorry, 0.5. Okay, so next company that we look at is 3M, which is, the ticker symbol is quite interesting. It's called MMM. So it's a multinational and multi-industry company. So what does this actually mean? And this is actually the full name of 3M, which is Minnesota Mining and Manufacturing. And they actually leverage in science and technology, R&D, to manufacture various product categories. So when we mention 3M, the first thing that comes to our mind is the adhesive tapes. But other than that, they are also involved in various industries. So they have a total of 4 business segments. First is safety and industry, which is something that we always see, the adhesive tapes. Next is transportation and electronics. Then also in healthcare, and also consumer products. So 3M is actually involved in all these 4 business segments. And they operate in more than 70 countries and produce more than 60,000 products. And the dividend yield that they generate is almost 5%. Okay, so now let's look at the numbers. The first thing is the revenue. We can see that it's a positive, consistent uptrend. Then next, we look at their EPS. It's also another consistent uptrend. And their cash flow is also another consistent uptrend. However, their debt to equity ratio is much higher compared to other companies that we've seen so far. So this is something that the investors should take note. And next, we will also look at Texas Instruments. So for Texas Instruments, it's actually a semiconductor company, and they manufacture various integrated circuits, which is the chipboards. And 95% are sold to electronic designers and manufacturers. So if you're interested to know more about semiconductors, you can look through our YouTube channel where we have covered some companies in semiconductors such as TSMC. And also 5% of the revenue is actually generated from calculators. So I get to know Texas Instruments is because of their calculators first before the semiconductors. And they have two business segments. The first one is analog, which they produce chip that controls the power and also to detect signals, which is power and signal chain. And then embedded processing, that means these electronic boards. Okay, so their products are actually used in different end markets, such as in industrial, automotive, personal electronics, communication equipment, all such. So they are actually the manufacturers for these chips, and they will sell all these chips to this end market to produce the end products. Like for example, automotive, we can think of is Tesla. And the dividend yield that they generated is about 2.85%. Okay, so now let's look at some numbers. So first off, their revenue, even though the early start since 2011 until 2013, it was a decreasing trend, but then the subsequent years, we can see that it's slowly increasing. And the EPS is a consistent positive uptrend. The cash flow is also another positive and consistent uptrend as well. And their debt to equity ratio, even though it's a bit high on 2020, but we can see that it's actually dropped to 0.57 in 2021. So these are the 5 companies that we have actually gone through that was recommended by the financial websites earlier. And of course, because tonight Kader is not around, and while I was doing a research, I found out that there's this thing called blue chip funds. So I decided to throw it in for tonight as a bonus. Okay, so what are blue chip funds? They are actually a type of mutual funds that was invested in stocks of various blue chip companies. So earlier on, the stocks that we look at are actually individual blue chip stocks. But if let's say, for example, some of the investors says that instead of investing in an individual stock, is there anything that I can invest in that involves various blue chip stocks? So blue chip fund is something that they can look at. And because of that, they have exposure to other blue chips companies and prevent from missing out the potential larger gains from other companies. Because certain period, maybe some blue chip companies will outperform other companies, whereas certain period, some companies will perform slightly bad compared to other companies. Okay, so here in Forbes Advisor, they actually did provide some recommendations, and the blue chip stocks that they recommended is some of these well-known names that we know of. But for this one, they also recommended some blue chip funds such as Fidelity Blue Chip Growth Funds, Invesco QQQ, Vanguard Dividend Appreciation ETFs. So now let's look at each of them to find out what are they and how they actually performed. So for this one, Fidelity, it is known as a diversified US equity growth strategy with large cap base. So when we first look at this, we don't know what it is. So to break it down is that it actually invests in at least 80% of their assets in the blue chip companies. And the companies that they invest in are actually above average growth potential. So this is actually what it actually means. And these are the top 10 holdings within these funds. So if you purchased these blue chip growth funds, that means you are also purchasing all of these companies as well instead of purchasing individually. So this is what it means to buy a blue chip fund. And let's look at their performance. So we can see that most of the years it actually outperformed the S&P 500 index. But during the pandemic times, it actually far outperformed compared to the index. But recently, it has slightly underperformed. So this is what Fidelity Blue Chip Growth Funds has been performed for the past 5 years. And next, we'll look at Invesco QQQ. So for Invesco QQQ, it's an ETF that tracks Nasdaq 100 index, but they only track non-financial companies within the Nasdaq stock exchange. So these are their top 10 holdings. So we can see that most of them, they are tech stocks, and excluding PepsiCo and also Costco. And this is their fund performance. So we can see that actually they outperformed the S&P 500 for the past 5 years. And we will look at Vanguard Dividend Appreciation ETFs. So for this one, they actually keep track of the S&P US dividend growers. So it means that they only invest in companies that have increased dividend payouts for the past 10 years. And these are their top 10 holdings. And we can see here within these ETF funds, we see that they include Johnson & Johnson, Visa, and also Home Depot that we mentioned earlier. So if you feel like you wanted to invest a lot more companies or in a basket of blue chip companies, this is something you can look at, but it's not a recommendation to buy, where further investigations will need to be done. And this is their fund performance. So we can see that actually, even though during the pandemic years, they have slightly outperformed, but overall it has been on par with the S&P 500. So if you are considering to buy something that has dividend, so this is something that you can also look at. So to conclude it all, some of the pros of a blue chip stock is that it's reliable, because that we see that some of the examples of the individual stock that they have a very steady growth and they have been around for many years and resilient. As such, they have a lower volatility compared to the current tech stocks. And also they offer dividend payouts where it's a kind of a regular income for investors. But because these are well-known brands, so the share price for these stocks are actually quite expensive. So you need to have a higher cost to purchase individual blue chip stocks. And the returns might be lower compared to the growth stocks. It's because they have actually grown quite big and they do not need to grow as fast as possible as the growth companies. So investors may need to invest for a long term to have substantial returns. So this is the overall information that we'll share about blue chip stocks. So right now, we'll come back to the question is blue chip stock a good investment in 2023? So in order to determine whether blue chip stock is something that you are looking into, Caden always said that there are two key preparations that you need before you invest. The first thing is the knowledge, which is know what to do and also know what not to do. So with this knowledge, you can determine that whether is the stock a good company to buy or not to buy, like what Warren Buffett says, understand what the business is all about. And also definitely you need to have the cash to make the investment. So here we actually have another video where all our past graduates actually shared their journey with us, like what they've learned and how is their performance. So let's watch this video.
The number one obstacle that will prevent me from investing is my bad past experience. I was scammed before, so I really am traumatized about it.
I'm more concerned about the losses that I may incur without proper knowledge.
So some of my friends and family has actually lost a lot of money in investments, and that was probably like the biggest obstacle that I have to overcome in order to make my first move into putting real money into an investment.
To be honest, I made some errors in the past in stock investment as well. I just put in money without knowing. After attending the VIA course, that was the most important turning point for stocks. Yeah, after that, the portfolio just went up and up.
I decided to source for a reliable training, and I found VIA. I took up the course and I learned that, okay, there is another side of investing, that we can do this very rationally.
I remember I did not fully comprehend the concept then. In the end, I attended VIA because Caden's life experiences and achievements were convincing.
Wow, investing has improved my life, especially the unusual strategy, the cash flow option strategy that Caden taught us. And plus, we know how to scan and screen for good and cheap companies. So I've been earning premium since last year, so it's been 1.5 years. So I have very regular passive income, and it really improved my life because I have a hope of an early retirement and giving more to my family.
So investing has definitely changed and improved my life by giving me back my time freedom. So a lot of people think that investment is about money, making money, but no, it's actually not. It's about what money can do for you, and the number one thing that it has helped me is that it has brought me back my time freedom. So right now I'm semi-retired. I get to spend a lot of time with my family, kids, and friends as well. And of course, I can go travel anytime I like because I don't have to worry about my finances.
by investing in right companies or stocks or whatever, I give a better chance to myself, my family, my children, a better starting line. In the future, they have more resources, they can do whatever they want to do.
I think what really put me to VIA was Caden. I attended his masterclass, I heard him speak, and I've heard other speakers speak for their own masterclasses. And Caden's humility and honesty was obvious, that this guy is not out there to get you to sign up. He's just there to show what he knows and let you learn about investing his way. So I found his honesty really, really enticing.
Well, I've heard other value investing presentations so far, and I found that Caden to be very sincere, knowledgeable, and I believe that he is teaching in a way where it is through his honest opinion and experience. So I think that is very useful coming from somebody who's you are trying to learn from. That's why I decided to go with Caden and VIA.
If you want to be financially free, learn from people who have the means. If you want to be rich, learn from the rich. Only those people can teach you these things. So I came to VIA searching for a mentor, and I think Caden is actually quite a perfect one because he gave us a mindset, and that was the most precious thing, a habit that he gave us for investing.
So in terms of investment results, in terms of ROI, is about 10 to 15% per annum.
1.5 years, I doubled my savings.
I have been investing for 3 years now, and proud to say that one of the stocks that I own is now a two-bagger. And a two-bagger means it has gained 200%, so I'm quite proud of that.
Since I started in October, November period, and by now it's about almost a year already, and I got about 29% of ROI, and I think that's fantastic considering the fixed deposit interest in Singapore. Thank you.
Hi everyone, welcome back. So I hope you have enjoyed the video where our graduates share with us their experience with VIA and also their achievements after they have graduated from our programs. And definitely, just now I was looking through the chat and yes, hi Angeline, Happy New Year and sorry for replying you late. And thanks to Julie as well to let us know that the new consumer health company by Jen is known as CanView. So thank you to you all. And with that, we'll move on. Where here, usually will be Caden sharing with us like how you should start off your investing journey, because we are currently offering a free value investing on-site masterclass on these dates, 19 January on a Thursday and the 1st February on Wednesday. So where you will able to learn how to generate 3 sources of passive income, even though you don't know what is investing about. So on this masterclass, you will know that what are the 3 ways that you can start generating passive income. And also, when people mention about investing, the first thing that comes to their mind is that it's very expensive. You need to have a lot of money. But here, Caden will show you how you can invest with minimal capital. And also, he will also show you how you can start to generate a cash dispensing machine to replace your existing salary. So to find out more, do join us in our masterclass. So when you decided to sign up with our masterclass, you first get a free book, which is Investla, that's worth about $33 in the bookstores. And we also give out a Starbucks gift card that is worth $10, where you can read the book while drinking a cup of coffee. And when the more you bring more friends, the merrier. So if you bring 1 or 2 friends, we will also receive 2 vouchers, which is $20 worth of NTUC vouchers and also a $20 worth of movie tickets, because right now GST has increased. So if you wanted to watch some movies like Avatar, we might think twice because the movie tickets has been increasing. So why not bring your friends along to get the voucher? So your friends will also receive the book and also the Starbucks card, but not the vouchers. So this all in all is worth about $43 plus priceless training from Caden. So with that, you can start registering, or you have any inquiries about the masterclass, or you feel that these 2 days does not fit with you, or is there any other dates that you wanted to join us, do write in inquiries at mindkinesis.com, and our friendly colleagues will also get back to you. And with that, I'll end the session for today. And at Value Investing Academy, we care to make you a better investors. So with that, I'll end this session for tonight, and I wish you all a happy 2023. Good night, everyone.